Microsoft reports a clean double beat and then loses almost 400 billion of market value in a single day. Not because they're failing, because they're succeeding too expensively. As I'm recording this, it's January 29th, 2026, and I want you to drop a comment with what time you're watching, because this is the moment the AI story flipped from hype to hardware reality. Today we're doing three things, fast and clean. What actually caused the 400B crash, even after strong earnings? The brutal hardware truth Wall Street is finally pricing in. It's not just GPUs. The pivot Microsoft is forced to make next, and why it changes the entire AI arms race. Let's start with the headline data, because the numbers are the plot. Microsoft fell roughly 12% in 24 hours. That's their biggest one-day drop since 2020. About $395 billion in market cap evaporated. And the irony is they beat expectations. Revenue around 81.3 B and EPS around 414. So why did the market punish good results? Because markets don't pay you for the past. They pay you for the shape of the future cash flows. And in the last few hours, investors stopped asking, how big can AI get? And started asking, how much does it cost to stay in the lead? That's the pivot. AI has moved from the discovery phase into the deployment phase. In discovery, growth is the headline. In deployment, the bill arrives. Now here's the first brutal truth investors latched onto. Brutal truth 1, OpenAI concentration risk. For the first time, the street is treating it like a structural exposure. About 45% of Microsoft's roughly 625B backlog is tied directly to OpenAI. Think about what that implies. Nearly half of the AI future is tethered to one engine. If OpenAI's growth slows, if the workload mix shifts, if they pursue different hardware partners, or if Microsoft simply can't scale capacity fast enough, you don't just lose a customer. You lose the narrative multiplier. And yes, Microsoft has other AI products. But the market is now pricing a new question. How diversified is that backlog really? When concentration rises, the valuation multiple gets nervous. That alone can compress a stock, especially after a long run. But that's not what made this move violent. The real punch came from brutal truth 2. The hardware bill is eating the margin story. Everyone watches Nvidia GPUs like they're the whole game. They're not. The AI factory has 4 killers: compute, power, networking, and storage. And storage is the silent assassin. New architecture breakdowns show Microsoft is spending close to 30% of AI revenue on storage at exabyte scale. Exabytes. That's not more drives in a rack. That's an industrial pipeline. Data ingest, data cleaning, sharding, replication, retrieval, checkpointing, and constant movement. Here's the nightmare. GPUs can sprint. Storage systems can't keep up. So the expensive part of your factory, your compute, goes idle. Imagine buying a fleet of race cars, and then discovering the fuel pump can't flow fast enough. The cars don't get slower. They just sit there. Estimates floating in the last few hours put that utilization gap at a staggering cost, around $16 billion a year in wasted efficiency, not because the chips are bad, because the pipeline feeding them is bottlenecked. And once you see that, you understand the 400B crash psychology. Investors looked at the income statement and said, even if demand is real, your cost curve is climbing faster than your pricing power. Now, brutal truth 3, CapEx fever. Microsoft's quarterly capital expenditure surged about 66% to roughly 37.5 B. That's not a normal corporate line item. That's a national scale build-out in one quarter. CapEx doesn't just reduce profit today, it creates a multi-year commitment. Depreciation schedules, maintenance, power contracts, cooling, fiber, real estate, and a never-ending cycle of refresh. So the market asked a simple, brutal question. Are we building an AI empire or an AI furnace? Because if the returns on those data centers don't scale as fast as the spend, you get margin compression. And margin compression is poison to a premium valuation. Now pause here. This is the moment most commentary gets lazy. They'll say, AI bubble popped. That's a bedtime story. This wasn't a collapse of belief in AI. It was a repricing of the unit economics of AI at scale. So let's translate the unit economics in plain language. In AI, your biggest enemy is not demand, it's utilization. You can have customers begging for inference. You can have enterprises signing contracts. But if your GPUs are waiting on data, or your networking is congested, or your storage can't stream fast enough, you're burning money while you grow. That's what the market just smelled. And that leads to the next act, the hardware pivot. On January 26th, Microsoft unveiled the Maia 200 chip. Built on TSMC's 3nm process, claimed to deliver about 30% better performance per dollar than Nvidia for inference. Read between the lines. This is Microsoft trying to escape the Nvidia tax. Not because Nvidia is evil, because buying third-party compute at massive scale eventually puts a ceiling on your margins. If you're paying premium prices for the core engine of your product, you become a reseller of someone else's economics. So Maia 200 is not a flex. It's a survival move. But here's the catch, and it's the cliffhanger nobody wants to say out loud. Building a chip is one problem. Building the entire system is the real war. A chip without software is a brick. A chip without memory bandwidth is a bottleneck. A chip without storage throughput is a parked Ferrari. A chip without a supply chain is a press release. So the market is going to watch one thing now. Can Microsoft improve end-to-end efficiency fast enough to justify this spending cycle? Because if they can, this crash becomes a reset. If they can't, it becomes a slow bleed. Now let's map the three routes from here, because nothing in markets has one outcome. Route A, the efficiency breakthrough. Maia 200 scales, storage architecture improves, utilization rises, the wasted 16B shrinks, margins stabilize, the stock recovers because the AI factory starts printing profit, not just revenue. Route B, the grind. Demand stays strong, but costs stay sticky. CapEx remains high, margins compress, but not catastrophically. The stock chops sideways while the business builds a new base. Route C, the pain route. Competition intensifies. OpenAI concentration becomes a real negotiating leverage point. Costs keep climbing. Utilization doesn't improve enough. The market stops paying a premium multiple for promise and starts demanding proof. The point is not to predict perfectly. The point is to understand what changed today. And what changed is this. AI is no longer a story you can sell with slides. It's a factory you must run with ruthless efficiency. So here's what to watch in the next updates. If you want to stay ahead of the headlines, watch backlog quality, not backlog size. How much is diversified across customers and products? How much depends on one engine? Watch CapEx versus utilization. Are they spending more and getting more productive compute, or spending more and parking expensive assets? Watch storage and networking disclosures. If management starts talking about data pipelines, throughput, and idle time, that's not nerd trivia, that's the margin battle. And watch the Maia 200 rollout, not the announcement, the adoption, the real workloads, the real performance per dollar, because that's where the Nvidia tax either gets reduced or it doesn't. Final thought. The 400B crash is not the end of Microsoft. It's the end of the easy AI narrative. From here, winners will be the companies that can turn silicon, power, and data into profit without burning their margins to ash. If you want, comment one word, hardware, and tell me which part you think is the real bottleneck. Compute, power, network, or storage. Educational only, not financial advice. Do your own research and manage risk. Now I want to slow down for 60 seconds because the most valuable part of this episode is the why behind the hardware pain. If you've never run large-scale compute, here's the hidden problem. AI isn't one workload, it's a conveyor belt. Training needs massive sequential reads, constant checkpoint writes, and endless retries when something fails. Inference needs ultra-fast retrieval, model weights, caches, vector databases, session memory, logs, guardrails, monitoring, and in both cases, you're moving oceans of data. That's why storage explodes from a support system into a profit-eating monster. A modern model training run can produce checkpoints measured in petabytes. You don't store one copy. You store multiple copies for redundancy, region replication, and rollback. You store datasets, you store augmented datasets, you store intermediate artifacts, you store evaluation traces, then you store customer data for fine-tuning, and you store the safety and audit trails around it. The world thinks AI is math. In reality, AI is logistics, and logistics has one unforgiving law: throughput. GPUs are built to swallow data at insane rates. If they're starved for even a few seconds, your utilization drops and your cost per token jumps. So you spend more CapEx to get less output. That's the furnace. This is why idle computing power is such a vicious phrase. Idle compute isn't idle cost, it's active loss. And this is also why investors finally snapped. They realized that in AI, the competitive edge is not only the model, it's the factory efficiency that turns electricity into answers. Now here's the second cliffhanger. Brutal truth. 4. Backlog is not cash. Backlog is a promise. And promises in the AI era come with escape hatches. Clients can delay deployments. Workloads can shift from training to inference. Usage can spike for a quarter and then normalize. If the cost to serve stays high while usage cools, margins compress hard. So when the market heard 45% tied to one engine, it didn't just think concentration, it thought volatility in the future revenue stream. And then it looked at 37.5B in quarterly CapEx and said, you're locking in the spend today while the revenue is still a variable tomorrow. That mismatch is the real fear. Now let's talk about the Nvidia tax without drama, because it matters. The tax is not an opinion about Nvidia, it's the physics of scale. When you buy the most advanced chips, you also buy the ecosystem around them. High-end networking, specialized racks, cooling and power density, software stacks, and the constant refresh cadence. At small scale, it's fine. At hyperscale, it becomes a structural margin ceiling unless you build your own alternatives. That's why Maia 200 matters. Not because it instantly replaces everything, because it's a negotiating tool and a roadmap to internal control. But again, a chip alone doesn't fix the factory. So here are the 5 tells that will decide whether today was a one-day shock or the start of a longer repricing. Tell 1. Utilization metrics. Listen for anything that implies higher GPU hours per dollar of CapEx. Tell 2. Storage architecture upgrades. Mentions of throughput, caching layers, faster interconnects, and reducing idle time. If you hear, we improved pipeline efficiency, that's code for, we stopped bleeding. Tell 3. Backlog composition. How much is diversified across enterprise customers versus one concentrated engine? Diversification lowers volatility. Volatility lowers multiples. Tell 4. Pricing power. Are they charging enough per token, per seat, or per workload to cover the factory costs? If pricing is competitive while costs rise, margins get squeezed. Tell 5. CapEx guidance and payback. If they start talking about payback periods, return on invested capital, or phase-gated build-outs, the company is telling you they heard the market's warning. Now, I'm going to end with one simple frame you can carry into every AI stock you watch. There are 2 kinds of AI companies, the demo company and the factory company. Demo companies ship excitement, factory companies ship efficiency. Excitement can lift a stock. Efficiency is what keeps it there. And today, Microsoft got graded on factory efficiency. So if you felt confused watching a double beat turn into a 400B crash, don't be. This is what happens when the story graduates. The grading rubric changes, and the next winners won't be the ones with the loudest announcements. They'll be the ones with the quietest unit costs. Before you click away, here's the 60-second watch list you can literally screenshot. First, listen for any statement about compute supply versus demand. If demand is ahead of supply, they will keep spending. If supply is ahead of demand, the market will punish wasted capacity. Second, track the ratio of AI revenue growth to infrastructure growth. If revenue grows 20% and CapEx grows 66%, that gap has to close, or margins get crushed. Third, watch for language around inference mix. Inference is where margins can improve, but only if the serving stack is efficient. If inference grows while utilization stays low, it's just more volume through a leaking pipe. Fourth, pay attention to storage, even if it sounds boring. When executives say data, you should hear cost. When they say latency, you should hear idle GPUs. When they say throughput, you should hear profit. And last, watch how quickly Maia 200 moves from slide deck to real workloads. If it shows up in production inference at meaningful scale, that's margin leverage. If it stays limited, they're still renting the core engine. That's the brutal truth behind today's move. The market didn't reject AI. It rejected inefficiency. Drop hardware in the comments if you want a follow-up breakdown of the AI factory stack. From power to networking, to storage to chips, with the simplest math I can make it. One more thing, crashes like this are often the market forcing a company to speak in numbers, not narratives. The next few quarters will be about proof, utilization, payback, and whether the AI factory can run hotter without burning cash. If you only remember one line, remember this. In the AI era, the moat is not a model. It's efficient delivery of compute at scale. Stay curious, stay skeptical, and never confuse a headline with the underlying machine. And if you're wondering why this matters beyond one stock, every major AI player faces the same physics. When cost per token falls, adoption explodes. When cost per token rises, valuations compress. That's why today's drop is a message to the whole sector. Show the efficiency, or the market will reprice you anyway. Next episode, I'll map the bottlenecks and the 5 metrics that predict the next move. Tonight,